Okay, hi everyone. Gonna be the second video here for chapter 21. So last time we talked about non-liquidating distributions. Now we're going to move and talk about liquidating distributions, right? And the idea with a liquidating distribution, really it's just kind of like we're moving along. Hey, the partnership is going to end. It pushes out whatever it has to the partners for their partnership interest. That's one way to do that, or it can just be the end of a specific partner on there with their interest. But the idea with this is if you are a partner, right, like you're Sonic and you get a liquidating distribution, we have to take your basis down to zero. And then we have to determine essentially, do you have a gain or loss, a recognized gain or loss from this distribution? And also, whatever it is they pushed out to you, what is your basis in those distributed assets? So things get a little bit wonky here. I'm going to try to go slow and break it out. As a general rule, right, the partnership and the partner do not recognize a gain or loss from a liquidating distribution. We'll see like consistently no gain or loss, no gain or loss. There are exceptions though, right? The first one is scenario 3, which basically says, hey, a partner recognizes a gain if they receive money in excess of their outside basis. The second one is scenario 1, that is to say a partner will recognize a loss when the distribution includes only money, unrealized receivables, and or inventory, so hot assets, and the partner's outside basis is greater than the sum of the inside basis of those assets. We will look at these one by one on here. One thing to be aware of, right? Any reduction in debt is going to be considered a distribution of money to the partner, and it reduces outside basis. So one of the things you have to be aware of right off the bat, we're trying to take our outside basis, right, whatever the beginning amount is, down to ultimately zero. We need to make sure kind of our starting point on that everything is up to date and where it needs to be. One of those considerations is any reduction in debt. So let's look at 2115 here. They're showing, in this case, right, essentially we have a partnership that liquidates. Sonic, in this case, is going to get cash and some hot assets. His share of liabilities, right, is 66,000. So he has his kind of outside basis there, and built into that are his share of liabilities. Well, after the fact, right, after a liquidating distribution, he doesn't have these liabilities, right? He's not a partner anymore. So the thing we have to do here is, right, here's kind of our beginning outside basis. We have to back out, right, from that, the debt relief. After this distribution, it's liquidating. We're no longer a partner. We're not on the hook for it. So we got to get our updated basis to start with. Once we get our updated basis and we apply the rules, right, we'll see that we have a capital loss here. Specifically, we're in scenario 1. The kind of key with this is going to be a running theme. We have to make sure that when we apply the rules for scenario 1 through 5, that we start with our updated basis in light of any debt relief. Okay? So, right, we said the idea here, the objective of a liquidating distribution, we're trying to take that outside basis and zero it out. It has to be zero at the end of the day. So we have in this case, right, maybe it's $200 is our basis. We have to, at the end of the day, get it to zero. They could give us different pieces of property that we use to take it down to zero. How we and what rules we follow when we take it down from like 200 to zero, whatever the case is on there, right? We have to adjust it to get it to where it needs to be. Well, the rules we follow that tell us how to do that depend on a couple different things, right? Essentially, does the partner's outside basis exceed the inside basis and vice versa? And then as well, what type of property is distributed? on there. The upshot of this is there's really only 5 scenarios, right? It's kind of like, if you go to Burger King or something, they're like, there's 6,000 ways to make a Whopper. You can have cheese, lettuce, tomato. Here, all we have when you look at the variables are 5 different types of or setups with liquidating distributions, right? In kind of the first general category, right, where the partner's outside basis exceeds the inside basis, we have scenario 1 and scenario 2. On the flip side, where it's less than the inside basis, we have scenario 3, we have scenario 4, and we have scenario 5 on there. We are going to look at each of these, right? It gets harder as we go through. I'm going to do the first few ones here, and then we'll kind of work our way through it, but I don't want to overload you on it. So we're starting with scenario 1. First off, our outside basis is going to be greater than the inside basis of the distributed assets, and the type of assets in this distribution are money and hot assets on there. In this case, right, if the partner's outside basis is greater than the partnership's inside basis in the distribution of only money, inventory, or unrealized receivable, then the partner is going to recognize a capital loss on there. So we said that's one of the exceptions. In this way, right, the partner is going to assign their basis to the distributed assets equal to the partner's inside basis. In other words, we're going to follow that general cash, then hot property, or hot items there. And any remaining outside basis is going to equal the partner's recognized loss. So we know we have a loss. When we want to quantify it, it's going to be kind of the leftover is the loss. Let's look at 2116. This is like very theoretical. It makes more sense with numbers on here. So we have a partner, right? They have an outside basis of 334. Their share of liabilities are 66. There's a liquidating distribution. Okay, first off, we got to account for that debt relief. This is kind of our adjusted outside basis where we're starting at on there, 268. They tell us, right, in this case, sorry, I'm kind of zooming all over here, that they're giving us cash of 159. They're giving us inventory with an adjusted basis inside the partnership of 49. So we're looking at 208 total here versus our updated basis of 268 on there. What do we do with this? So essentially what's going on here, we're going to take our updated basis, we're going to back out what it is we got, right? The basis of the distributed property, and the leftover, right? This is kind of our leftover basis is going to equal our loss. In short, right, if you just think about this, right, our partnership interest is worth 268 and they only gave us 208 out, right? It's like if you bought Apple stock for 1,000 and then Apple was like, sorry, we're going out of business, you get $700, you'd have a capital loss. Here we have a similar setup, right? The leftover amount, or that kind of idea there, the difference between that, that's going to be a capital loss. We didn't get all of our, as it were, basis back on there. Here's a couple kind of iterations of that. It's a liquidating distribution. Here it's just cash, right? So, hey, we're at 24. We back out the cash. This kind of leftover, right? That's going to be the loss. So there's an example just with cash on there. Here's an example with cash and hot assets, right? We're still in scenario 1 on each of these, right? We have our beginning basis of 24. Do the cash first. Do the hot assets. Hey, the $9,000 on there, the leftover, that's going to be our loss. If I said to you, hey, what are your basis in those assets, right? Well, it's just going to carry over, in this case, $10,000 for them. And then obviously your basis in the cash is going to be $5,000, right? The basis in the cash is always the cash amount on there. But in this way, right, we have enough basis to absorb all this. We're really just frowning, right? We didn't get all our money back we have a loss here on this. Let's compare that with, right, here's where things start to get a little bit more complex in scenario, the scenario analysis. So now we're in, right, that was scenario 1. We can put a check mark. Now we're looking at, so this is relatively easy. Right, we're going to look at scenario 2, which I would say is kind of medium on there. Next, scenario 3, I would say is easy. And then these guys over here are a little bit hard on there. So just to give you the lay of the land. But we can check off scenario 1. That's great. Now let's move to scenario 2, what we're doing on here. So scenario 2, what's the setup, right? Our outside basis is going to be greater than the inside basis of the distributed assets. And here, other property is included in the distribution. In other words, it could be cash, it could be hot assets, or it could be other, right? When we say other, we just mean some type of property that isn't cash and isn't a hot asset on there. What they're telling us what we have to do here is follow the ordering rules, right? So cash, then hot, then other, to kind of reduce that basis down on there. And then we have kind of a split, like a fork in the road here, right? We're trying to take it from, $200 the basis. We know we got to get to 0. If we have in this kind of allocation of first, second, third, if we have just a single item of property left, right, we're going to adjust the basis to any remaining outside basis. Overall, no gain or loss on this. I know that's a mouthful. What does that mean? Let's look at 2117, then we'll look at another simple example over there. All right, we have a partnership. They make a liquidating distribution. Our outside basis is 268. We'll just say that's like our updated basis. They're giving us cash with $50,000. Then there's land, other property with an adjusted basis of $20,000. If we're to total that, right, 268 is greater than 70. What they tell us here, right, this 268, we have to eventually take it down to 0, right? That's the end goal here. We follow the ordering rules, cash first, right? Then there's 218 left. On there, essentially what we're going to do is, and we're kind of compacting it there, but this remaining 218, it's just a single piece of property that we're allocating it to. We're going to force calc that down to 0 in that case on there. So we're departing from, even though the adjusted basis in this case is 20, right? Whatever, in this case, how we take that down to 0, right? That's going to be essentially assigned to the other property on that case. Let's look at another example here from this guy right here. It says, and we're looking at scenario 2, right? We have tax basis is 24,000. They received, a liquidating distribution of $5,000 cash. So we're going to do that first. And then they also have real estate, which is going to be other property, fair market value of 20, and an adjusted basis of 10. Essentially, what's going on here, right? We're not going to have any gain or loss, right? We're going to follow the general rule. And then here we're taking the basis down, right? The ending basis will eventually be, and we have to take it to 0, but we do by the cash. And then when we're at this $19,000, we'll essentially take it down by that. And that sort of force calc will become our basis in that other property on there. That's where you have like one piece of property, or it's like a single item where you got to take it down to 0. Things get more complex because when you're following this ordering process, you could have multiple pieces of other property or other kind of items here to get you down to 0. Then you have to allocate on there, right? So it says here a liquidating distribution that includes multiple items of property that, when applying the ordering rules, are not fully utilized allocated before the outside basis hits zero. It gets more complex here, right? Essentially what we're doing is step one, right? So we have our outside basis. Let's just say it's $500, right? We have to reduce it by the total inside basis of all the assets. Then we reduce it by which assets have appreciation. That is to say, they have gone up in value. Their fair market value is above their adjusted basis. And then for the remaining basis, we have to allocate on here. Again, a mouthful. You're not going to hear once. That's why I'm doing this in multiple videos. Let's look at problem 2118 on here. Okay, we have a partnership that makes the following distribution to a partner. At the time of the distribution, they have an outside basis of 334, 66 of the liabilities. We know we're going to have to update that. They want to know what's the outcome here. So essentially, this will be the end result, right? Whenever we figure out like the end of the rainbow on there, but how do we get there, right? First thing we got to do is get our updated basis, account for that debt relief. Nothing, too big there. We've seen that over and over again on there. The next thing we do is we're going to take that number, right, the 268 from up there. We're going to back out the total inside basis in the assets that are distributed, right? So we're at 268. We back those out. Where do we get those numbers? Right from up here. In this way, right, when we do it, right, you can see 5, 10, 43 on there. Then we have 29 that's left, right? But we're kind of doing the story where we have to take this thing to zero, right? Then what we do is, right, we're going to look at those items that have appreciation. This is the one time, right, when you're doing liquidating distributions where you do not ignore the fair market value. In other words, you have to compare these things and see which one of these items have gone up in value, right? So if we go and we look at it, right, the investment A has gone up. In this case, we bought it for 5. It's now worth 12. It's appreciated by 7, 10 to 13, right? It's gone up in value by 3 on there. So we essentially look at those items that have appreciated, and we're going to do the appreciation next. So 29, the 7, the 3, we're at 19 left on there. Again, we're trying to get this down to 0. Now we have 19 that we have to deal with. This is where we're going to allocate the remaining basis, essentially between, as we go back here, right, the other property, right? And this is just the other property. It's not the hot, right? It's just the other, right? So we did the appreciation. Now we have to break it out during this formula. The remaining basis times the fair market value of the asset times the total fair market value of the other on there. So that's this guy. Our remaining basis, 19. The other over the total other. That is how we break it out on there. The end of the day, right, you can see here we start with investment A, investment B. We have to make the adjustments. There's our ending basis, 21, 22 on there. That comes up and gets us to this sort of end of the rainbow number on that. Not something you're going to hear once and immediately get. Let's look at another example of this scenario too. Oops, sorry. All right, so Garrity's basis in his partnership is 529. He receives a liquidating distribution, right? So 529, we have to take this thing down to 0 because it's a liquidating distribution. They tell us, hey, there's some cash, there's some inventory, right? There's a hot asset, and then there's some land, which is other property on there. They want to know, please tell us Garrity's basis in the property distributed and his basis in the partnership immediately after the distribution. Well, it's a liquidating distribution, so at least one item we can get right off the bat. It's 0. However, right, we're going to have to look at and say, oh, okay, this is scenario 2 on there. We have to first take the basis, 529, and back out the total inside basis of the items, 314 over here. Right, there's the total inside basis, 314, back that out. Now we're at 215, right? We then go up here and we say, which of the following items of the other items have appreciated, right? So we go over here, well, this hot, that's not another item on there, but the land, right, that has gone up, that's another, it has gone up by 200,000. So with that, we'll deal with that there. Of the remaining, right, so we're at 215, we have 15 left to account for. What we do in this case is we look at the other property, right, these are our other, and we basically say we have to divide it between them on there. So this is our remaining basis decrease, 15,000. Essentially, we do it times the relative amount over the total. Here we break out the 5. Here we break out the 10. It ultimately gets us to 0 on that. At the end of the day, right, when we look at, step 1, right, what's our basis in the distributed assets, right? Well, cash, our basis is the cash. Inventory, our basis is a carryover basis. Land, right, we're going to have step 1 where we use the total amount of 200 grand. We didn't touch that in step 2, but we had $5,000 there. So we're at 205 for the land, lot A. When we look at lot B, right, what we have here is, again, from step 1, from step 2, right, that was the only one that had appreciation on there. So it was 100 in step 1, 200 in there, and then 10 from here, right, we're at 310. Add them all up, foot them. Here's what we did, right? Our $529,000 basis, how we took that down to 0, 314, 215 on there between step 1, step 2, step 3. Here's our ending basis in those items we received. And oh, by the way, our ending basis in the partnership is 0. That is a mouthful. That is complex math. It's not something you're going to hear once. That's why, I don't want to go too far down the rabbit hole in this video. Let's look at one more scenario here on it. Actually, let's just pause here. We're going to finish there for this video because we have scenario 1 done. We have scenario 2 done, right? We'll next look at in the upcoming video scenario 3 where it's less than, and we'll take it from there.